They're all different, right? And they're effective in different ways. So if you are a solo angel, you're investing your own money, nothing is stopping you from investing in the craziest thing you can think of or a safe thing you can think of. You can make a decision instantaneously, and you live with what you invest. And in theory, if you're good at it, you'll make money and you'll keep doing it. And if you keep making bad decisions, you'll stop being a solo angel. Angel groups, on the one hand, you're benefiting from the experience and input and wisdom and thought processes of multiple other angels. And because they are joining an angel group, they are at least in the same universe that you are. Somebody who's totally risk averse is not joining an angel group, right? So the average angel investor has been an entrepreneur for 15 years and has started 3 companies. So you're people who are sort of like you, and they're sort of willing to take risks. And the fact that they've joined a group and are angels means they are inclined to make an investment. But you're right, there is still groupthink, and there are some people who will be more conservative. So on the one hand, it might tend to stop you from investing in crazy things that you should never invest in because you're hearing some common sense from other people. But on the other hand, it may indeed, prevent you from, making your own investment in something that's a wild, crazy thing, which is why most angel groups are great for bringing things in. But, as a group, they will only, make a round robin investment in a few deals. But individual angels can still say, okay, I know the group didn't want to do it, but I like this deal, so I'm going to invest anyway. Right. And so you can still do that. With venture funds, especially funds that are not just a single VC seed fund, but they have a partnership. Typically, if they're a good VC fund, those VC partners have gotten together. They believe they are simpatico. They are clearly willing to take risks and invest in this space if they're an early stage VC, because that's how they raise their funds. They signed up with their partner because they believe they each have something different to bring to the table. And I know for a fact, being primarily an entrepreneur, I'm a future thinking, far future, risk taking, whatever. And it's very helpful to me to have somebody who's a little more grounded advising me and working with me and discussing things through to say, okay, yes, sure, it'll change the entire world and we'll go to Mars next week. But in the real world, what do we do, right? So, and that's why venture funds, when they work, tend to be able to make the big hits. But there are, remember, 2 very different sort of types of venture funds. The traditional big funds that are investing in a Series A or forget to. Often when I talk to investors in private equity, they say, well, yes, we're an early stage, PE investor. I say, great. What does early stage mean to you? They say, oh, we'll invest as early as Series B. Okay, right. Fine. I'm investing before anybody ever heard of the term series, right? I'm investing with a guy in a garage. So typically venture funds have invested at Series A. For an angel, Series A, that's like your exit. That's like the end of the day coming out here, right? So they are prepared. If they are investing at that kind of level, they are looking for a lot of traction. The company has been de-risked a whole lot, and now they are betting that their money can be used to expand the company, not start the company, right? Angels who are investing really, especially in a pre-seed round or an angel round, are investing before any proof of anything, really. We say we demand traction, and we really want traction, but it's still typically well below product market fit, well below everything else. So you're investing on founder market fit kind of thing. And so that's an interesting challenge to do, and that's why angels tend to invest in these crazy early stage deals and VCs tend to invest later. A seed fund or pre-seed fund, a venture fund, where you have effectively, it's a small fund, 5 million, 10 million, and the kind of funds that you're doing, where you essentially have one former angel, now sophisticated angel, who is making decisions. You can be sort of the best of both worlds, right? You don't have a big, long partnership thing to go through. You can make a decision, but you're being, in the back of your mind, you've got LPs there, so you have to be serious. You can't just take a flyer and a gander. You have to be serious about what you're doing. So you may be in just the right sweet spot here.
So I ask the questions because most of the times the great companies are non-consensus companies. So you have huge arguments on the companies because nobody knows in the early stage. So how do you make your decisions based on intuition or data? Because in the early days, there's few data.
But that's exactly the challenge of early stage investing, even up to the VC level, right? Certainly at the angel level, which is that you never know. And nobody retroactively, there's no guarantee up front. I don't care how great you are. There are a very, very few people who are what I call pickers. They are people who just have that sixth sense and they've just done with incredible things, right? I mean, so people like Josh Koppelman at First Round Capital, Fred Wilson, maybe early on, there are a few people who just just have that, je ne sais quoi. I don't know what it is, but they have it. Right. And in every industry, there are people who have a virtuoso violinist, right? And no matter how hard you practice, you want to equal it. So but putting aside those for regular, normal, ordinary, and I am not one of those, right? I am not a picker like Josh is. I'm a rational guy. I'm enthusiastic. I'm an entrepreneur. And so I would that I make all my decisions on the basis of actual data and so on. But I don't, because I'm an angel, and most angels really don't. So with most angels, despite what they say, despite all the numbers and stuff they can give you, it's really intuitive. And so what you can try and do, if you're not one of the pickers who has this sort of perfect sense of, and even they still miss 80% of the time, but the question is the other 20%, they get unicorns, right? So, but if assuming that you are going to be a rational angel, and my book, by the way, was written for those people. My book was written for rational people, or at least semi-rational, trying to be an angel investor. Right. And so the thesis of the book is get a really big, wide deal, understand what you're doing, decide what you're going to invest in, get a very big deal flow, and then at least understand the basics of what does traction mean, how do startups work. And so when you look at it, you're not missing the obvious, right? If something is not going to work, it's not going to work. And so typically you can see that early on. That being said, you're then going to try and go for the gut instinct, the intuitive thing for the big future. One of my most fun investments, for example, was a company that I saw at a New York Tech Meetup. A New York Tech Meetup actually still is, but it's less than it used to be. But it was a monthly meeting where people in the New York tech community would show off their current tech. It wasn't pitching. You weren't allowed to discuss business models. You weren't allowed to, to pitch. It was all about showing off tech. This guy gets up and shows off tech for bike sharing. And now bicycle sharing at that point had just begun to be a big thing. And there were bicycle share things in New York and Washington and California, and a bunch happening in Europe. But the first generation bike sharing was basically like in Amsterdam. You would, take a bike and leave it on the street corner and lock it up on a thing. And then everybody would have a key and you got to unlock the bike. The problem is you couldn't keep track of them and it was a mess. Second generation said, oh, okay, we're going to use technology and we're going to have these hubs, these smart hubs. And you would take your bike and you would lock it into a hub. So now we know that the bike is there. You can unlock it with a card and so on and so forth. Presenting a New York Tech Meetup said, okay, we're going to do a third generation bike share, and we're going to take the smarts out of the hub and put it on the bike. So now every bike is, instead of having a smart hub, you'll just have you can lock it anywhere, but every bike will have GPS and a built-in lock and a built-in control, and you can see where it is, and you can unlock the bike and charge it, and then just lock it back up to a lamppost or whatever it is. And so once you do that, all of a sudden, it's now Internet of Things. You've now taken and made each of these physical bikes a digitally controllable thing. You can change the rates, you can figure out where they are, you can move bikes. I thought this was really cool. I mean, because my background is in urban planning, so I love the idea. And so after the meeting, I rushed onto the stage and said, as he was coming off, I said, I got to invest in this kind of company, right? And so we started talking, and it turned out that he had started, a total entrepreneur, but he was a first-time entrepreneur. He'd never started a business. He'd never worked for a company before. He had started this thing, and he used his mother's money to build the first bikes in China, and they were coming over, but they couldn't even get them out of the container because they couldn't pay the import duties in the U.S. But I looked, and so that was an intuitive thing where I didn't do a whole lot about the numbers, but I thought the concept was really, really big. And so I led that round as an first investor. I became chairman of the board. It was called Social Bicycles, and they spent 5 or 6 or 7 years trying to get this thesis into the bike community. And they ended up they had some big company, pretty good thing. And then pivoting and adding on it, they hit on the idea of powered bikes, of electric bikes that were pedal assist bikes. And they were the first people to do that. And they came out with that, and they got a deal with San Francisco. So they were the first bike share allowed to test these bikes in San Francisco. And it worked really, really well. Along the way, they changed their name to Jump Bikes. And then they started, all of a sudden, they hit it. And that was their experience in bike share. The cities they were in and this thesis, now that everybody else was beginning to get onto the idea of, put the intelligence in the bike so you can see where it is and check on your smartphone and unlock it, which is now the standard way of doing these bike shares. These guys pioneered that. And then PS, all of a sudden, they found themselves in a very hot market. They had term sheets from all the major VCs, and they ended up getting acquired by Uber. And that was the beginning of Uber Bikes. So from this little company that I had seen and was the first investor in. And so that was a case where I had made an intuitive decision, spent a lot of time working and adding value with the other investors on the board and helping the CEO and then helping them to an exit, and everybody benefited.
In this case, you know the vertical and the industry. If you don't know the industry or the vertical, Do you
It's
invest?
or
What do you do in this case?
if you don't know the vertical and you don't know the industry, you should be very careful about investing. That's not a great match, right? Even if you totally know the industry and the person and the model and you see it, it's still going to be a 1 in 10 chance of being successful. If you have no idea about the industry, anything sounds good. I mean, if you don't know, I can give you a perfect pitch. I can convince you to invest in something in an area that you're not in because you don't know anything about it, right? And so very often that's a problem for founders as well. It's like, I joke that it's like a founder pitching me a new building, a real estate building, a building in New York City, and he's got a wonderful site. It's going to be a giant skyscraper in the middle of an 8-acre open area right in the middle of Manhattan. And so I should just invest in this building. So my question would be, okay, there probably is a reason why nobody has built a building before in the middle of Central Park. And if you don't know what that reason is, you probably shouldn't be doing these things. So similarly for investors, if you really know nothing about the market, that's not a considered angel investment. You could be taking a gamble, you could be investing in a friend, you could be doing something else, but that's not the way you should really, if you want to invest in that area, go learn the business, right? And by the way, investing a little bit of money in one startup in an area that you want to know about is actually a pretty good way to learn about it. So if you know going in, you're not doing it to make money, you're going in it to learn, then putting in 25 into a med tech device company or whatever, or a drug discovery or a SaaS platform, if you're really willing to see what they're doing and watch and talk to the CEO and read all the reports and learn about the industry, it can give you some very interesting insight, but you shouldn't be trying to make money in an area about which you know nothing.